If you woke up on January 30th, 2026 and checked your silver position, you saw something that defied the laws of physics. You saw the price of silver, a metal that had been climbing relentlessly for months, a metal that had touched $121 per ounce, suddenly collapse, not drift down, not correct. Collapse. In less than 6 hours, silver lost 30% of its value. It went from $121 to $74. And if you were watching the screens, if you were there in real time, you know what I'm talking about. You saw the candles. You saw the volume spikes. You saw something that looked like a controlled demolition. And here's what they told you. They told you it was profit-taking. They told you the Fed was going to raise rates. They told you it was a technical correction. They lied to you. Because on that exact same day, January 30th, while silver was being destroyed on the Comex, while retail investors were getting margin called and liquidated, while the talking heads on CNBC were saying this was healthy, this was normal, something else happened. The Metropolitan Capital Bank and Trust in Chicago failed. It didn't just have a bad quarter. It didn't just miss earnings. It failed. The FDIC stepped in, the doors closed, and it became the first bank failure of 2026. Same day, same exact day. And if you think that's a coincidence, if you think that the largest one-day crash in silver in modern history happening on the same day as a bank failure in a major American city is just random chance, then you haven't been paying attention to how this game is played. Let me tell you what really happened on January 30th. Let me walk you through the crime scene, because that's what this is. This is a financial crime scene. And the evidence is everywhere if you know where to look. The crash didn't start at 9:30 in the morning when the New York markets opened. It started at 2:15 in the morning. 2:15 and 33 seconds to be exact, Eastern Standard Time, while you were sleeping. While the American retail investor was in bed, the algorithms were already moving. The price started dropping in the Asian session. Small moves at first, testing the waters, then bigger, then catastrophic. By the time New York opened, the damage was already done. The price had already fallen from 121 to 92, a $29 drop before most Americans had their first cup of coffee. And here's where it gets interesting. At exactly 9:47 a.m. Eastern, the CME Group, the Chicago Mercantile Exchange, the entity that controls the Comex where silver futures are traded, announced an emergency margin increase. They raised the margin requirements on silver futures by 42%. 42%. Overnight. No warning, no gradual implementation. Just a sudden, brutal increase in the amount of collateral you need to hold a silver contract. And what does that do? It forces liquidations. If you're holding silver futures on margin, and suddenly the exchange says you need 42% more cash in your account, you have two choices. You either deposit more money immediately, or your position gets liquidated automatically. And most traders, especially the smaller ones, the retail guys, they don't have 42% more cash sitting around at 9:47 in the morning, so their positions got sold automatically by the system into a falling market. Now think about the timing. The price starts falling at 2 in the morning. The margin hike gets announced at 9:47. The crash accelerates, and by noon, silver is at $74. That's a $47 drop, 39% from the peak, the largest single-day percentage loss since the Hunt brothers manipulation was broken in 1980. And they're telling you this is normal market behavior. They're telling you this is just volatility. They're telling you that a metal that has been in a structural supply deficit for years, a metal that is essential for solar panels and electric vehicles and AI data centers, a metal that China has been hoarding by the ton, suddenly became worth 30% less in 6 hours because of profit-taking. But here's what they're not telling you. Here's what the mainstream financial media will never report. While the price of paper silver was collapsing on the Comex, while the futures contracts were being liquidated and the spot price was cratering, something very different was happening in the physical market. Because on January 30th, the same day as the crash, the Comex registered vaults, the actual physical silver warehouses that back the paper contracts, they started hemorrhaging metal. Not slowly, not gradually, in a flood. In the week following January 30th, from January 30th to February 6th, 33.45 million ounces of physical silver were withdrawn from the Comex vaults. 33 million ounces, gone, removed, taken out of the registered category, which means taken out of the pool of metal that can be used to settle futures contracts. Let me put that in perspective for you. The total registered silver inventory at Comex at the start of January was approximately 98 million ounces. That's the physical metal that backs all of the paper contracts trading on the exchange. So in 1 week, 34% of the registered inventory disappeared. Think about that. The price crashes 30%, and 1/3 of the physical supply vanishes. Does that sound like a market where there's too much supply? Does that sound like profit-taking? Or does that sound like the people who actually understand what's happening, the people with access to the vaults, the bullion banks, the commercials, the insiders, were using the price crash as cover to acquire physical metal at a discount while shaking out the retail speculators? And here's the smoking gun: the lease rates, the cost to borrow physical silver. On January 29th, the day before the crash, the 1-month silver lease rate was negative 0.1%. Negative. That means people were paying you to take their silver. There was so much paper silver sloshing around the system that the lease rate went negative. But by February 5th, 6 days later, after the crash, after the drain of 33 million ounces, the lease rate had spiked to 8.3%. 8.3%. That's not a normal move. That's not a gradual shift. That's a market screaming that there's a physical shortage. That's a market where people who need to deliver actual metal are desperate to find it, and they're willing to pay 8% annualized to borrow it for a month. You know what that's called? That's called backwardation. That's when the spot price or the near-term price is higher than the future price. And in a normal commodity market, backwardation shouldn't exist for long because it creates an arbitrage opportunity. You can buy the future, take delivery, and sell it in the spot market for a profit. But that only works if there's actually metal available to deliver. And what the lease rate spike is telling you is that there isn't. The vaults are empty, the physical market is tight, and the people who sold paper silver at $121 on the way up are now scrambling to find real metal to cover their positions. And this is where the Metropolitan Capital Bank comes in, because Metropolitan Capital wasn't just any bank, it was a regional commercial bank based in Chicago with significant exposure to commercial real estate loans. And if you've been following the commercial real estate market, you know it's been a disaster. Office vacancy rates in major cities are at all-time highs. Nobody's going back to the office. The buildings are empty, the landlords can't pay their mortgages, and the regional banks that lent money to those landlords are holding worthless paper. Metropolitan Capital had a loan portfolio that was heavily weighted toward commercial office space in the Chicago metro area, and when those loans started defaulting, when the property values collapsed, the bank became insolvent. The FDIC stepped in on January 30th and shut it down. Now here's the thing. The FDIC doesn't shut down banks on a random Thursday morning without warning. Bank failures are planned events. The regulators know weeks or even months in advance that a bank is in trouble. They monitor the capital ratios, they review the loan books, they know when a bank is going to fail. So the fact that Metropolitan Capital was closed on January 30th means the FDIC knew it was coming, the Federal Reserve knew it was coming, the Treasury knew it was coming. And if they knew Metropolitan Capital was failing, they also know how many other regional banks are sitting on the same toxic commercial real estate loans. They know how many other banks are technically insolvent but haven't been shut down yet because closing them all at once would cause a systemic panic. And that brings us to February 4th. 4 days after the silver crash. 4 days after the first bank failure of the year. On February 4th, the Federal Reserve released a stress test scenario. Not the official annual stress test, but a supplementary scenario. A hypothetical exercise that the Fed uses to model what would happen to the banking system under severe economic conditions. And the scenario they released was apocalyptic. It assumed a 39% decline in commercial real estate prices, a 10% unemployment rate, a severe recession, and the results showed that multiple large regional banks would fail under those conditions. They would be unable to absorb the losses, they would need to be recapitalized or shut down. Now, the Fed will tell you this is just a hypothetical scenario. They'll tell you it's a planning exercise, they'll tell you it's not a forecast. But let me ask you something. If the Fed is stress testing for a 39% crash in commercial real estate, do you think they pulled that number out of thin air? Do you think they just randomly chose 39% because it sounded scary? Or do you think they chose 39% because their internal models, their proprietary data, their access to every bank's balance sheet in the country is telling them that a 39% crash is not only possible but probable? And if it's probable, they are symptoms of the same disease. The disease is monetary collapse. The disease is systemic insolvency. The disease is the end of the fiat currency regime. And in the days that followed, the evidence piled up. 33 million ounces drained from the Comex. Lease rates spiking to 8%. The Fed releasing a stress test that assumes a 39% crash. A bank strike in India disrupting the global physical market. China continuing to buy regardless of price. The physical market in Asia decoupling from the paper market in the West. All of it pointing to the same conclusion. The system is breaking, the manipulation is failing, the physical metal is disappearing, and the price is going to explode. The people who run the system thought they could control it. They thought they could crash the price, shake out the retail investors, drain the vaults, cover their shorts, and reset the game. But they underestimated the demand for physical. They underestimated the awareness of the manipulation. They underestimated the desperation of people who are watching their banks fail, their currency devalue, their purchasing power evaporate. Those people aren't selling, they're buying, they're taking delivery. They're removing metal from the system, and every ounce that gets removed makes the next ounce harder to find, makes the next default more likely, makes the next price spike more violent. And that's where we are right now. We are in the eye of the hurricane. The first wave hit on January 30th. The price crashed, the bank failed, the software bubble popped. But the price recovered. It bounced from 74 to 82. The physical buyers stepped in, the market absorbed the shock, and now we're in the calm, the temporary calm before the second wave. And the second wave is going to be bigger, because the fundamentals are worse. The vaults are emptier, the banks are weaker, the Fed is more desperate, and the awareness is higher. So what do? You do what the smart money is doing. You buy physical, you take delivery, you get it out of the system. You don't trust the ETFs, you don't trust the futures contracts. You don't trust the banks, you don't trust the government, you trust the metal, because the metal is real, the metal is scarce, the metal is money. And when the system collapses, when the banks fail, when the currency hyperinflates, the metal is what's going to preserve your wealth. The Fed has shown you their cards with the February 4th stress test. They're preparing for a 39% crash in commercial real estate. They're preparing for bank failures. They're preparing for a severe recession. They know what's coming. And if they know, and they're preparing, then you should be preparing too. Not next month, not next week, now. Because the Metropolitan Capital Bank won't be the last failure. It's the first. And the time between the first and the second is always shorter than the time between the second and the third. The cascade is starting. The dominoes are falling. And silver, physical silver, is the lifeboat. January 30th was the warning. The crash, the bank failure, the software collapse, they were all warnings. The question is, are you listening? Are you paying attention? Or are you going to wait until silver is back at 121, 150, 200, and then wonder why you didn't act when it was at 80? The window is closing. The physical market is tightening. The vaults are emptying. The lease rates are spiking. The system is breaking. And the people who understand what's happening are positioning themselves right now. Not later. Now. Follow the money, follow the physical flows, follow the lease rates, follow the vault inventories, follow the bank failures, follow the Fed stress tests. All of the data is pointing in the same direction. The system is insolvent. The collapse is inevitable. And the only hedge, the only real protection, is physical metal in your possession, not in a vault, not in an ETF, not in a futures contract, in your hand, under your control, outside the system. That's the lesson of January 30th. That's the message the market is screaming at you. The price crashed, but the physical disappeared. The banks are failing, but the metal is being hoarded. The Fed is preparing for catastrophe, but the insiders are accumulating. And if you're not doing the same, if you're not buying physical, if you're not taking delivery, then you're on the wrong side of the greatest financial shift of our lifetime. The clock is ticking, the vaults are emptying, the system is breaking. Get your metal, get it now, and get it out of their hands. Because when this thing goes, when the confidence breaks, when the run starts, there won't be any metal left to buy at any price. It'll all be gone, locked up, hoarded, held by the people who saw it coming and acted. Don't be the person who waited. Don't be the person who believed the CNBC narrative. Don't be the person who thought $74 was the bottom and 121 was the top. Be the person who understood that January 30th was a gift, a chance to buy physical at a manipulated price before the manipulation fails completely. Be the person who followed the money, who saw the bank failure and the vault drain and the lease rate spike and put the pieces together. Be the person who acts. Follow the money, where every wedding, every festival, every major life event involves buying gold. And when the banks shut down, when people can't access their accounts, what do? They buy more metal, they hoard it, they take it out of the system. And that creates a supply shock in the global physical market. So now you have supply shocks in the United States from the Comex drains, you have supply shocks in India from the bank strike, and at the same time you have China, which has been the largest buyer of gold and silver for years, continuing to accumulate. The Chinese central bank has been buying gold every single month for over a year. They're not slowing down, they're not waiting for a better price. They're buying regardless of price because they understand that the dollar is losing its reserve currency status, that the Western financial system is collapsing, that the future belongs to countries that hold hard assets, and they're positioning themselves accordingly. And here's where it gets really interesting. If you look at the Shanghai Gold Exchange, the physical gold price in China, and you compare it to the paper gold price in London or New York, there's a spread. The physical price in China is higher, sometimes significantly higher. And the same thing is starting to happen with silver. The physical price in Asia is decoupling from the paper price in the West, because in Asia, people want the metal. They're not interested in ETFs. They're not interested in futures contracts. They want bars. They want coins. They want physical possession. And when physical demand exceeds physical supply, the price goes up, regardless of what the paper market says. So what you're witnessing is the beginning of a two-tier market. A paper market in the West where the price is still being managed and manipulated by the central banks and the bullion banks. And a physical market in the East where the price is determined by actual supply and demand, and eventually those two markets are going to completely decouple. The paper price is going to go to zero because nobody will trust it, and the physical price is going to go parabolic because that's where the real scarcity is. And this is why January 30th matters. It's not just about a one-day crash. It's about what that crash revealed. It revealed that the system is fragile, that the banks are failing, that the commercial real estate market is collapsing, that the software bubble is popping, that the physical metal is disappearing from the vaults, that the lease rates are spiking, that the backwardation is real, that the Fed is preparing for a 39% crash, that the rotation from intangible to tangible is accelerating, and that the people who control the system are getting desperate. Because that's what the margin hike was, desperation. That's what the forced liquidations were, desperation. That's what the coordinated crash was, desperation. They needed to shake people out, they needed to create panic, they needed to buy time. Because they know what's coming, they know the end game, they know that the monetary system as we know it is ending. That the dollar is losing its status, that the banks are insolvent, that the only real money is gold and silver. And they're trying to accumulate as much physical metal as they can before the general public figures it out. But here's the thing, the public is figuring it out. The drain of 33 million ounces in 1 week proves it. The spike in lease rates proves it. The recovery of the price from 74 to 82 in 11 days proves it. The premiums on physical coins and bars prove it. People are waking up. People are seeing through the manipulation. People are buying physical and taking delivery. And once that process starts, once the confidence in the paper market breaks, it's game over. Because you can't print gold. You can't print silver. You can't create physical metal out of thin air. And when the demand exceeds the supply, the price has to rise. It's not a matter of if, it's a matter of when. And the Fed knows this. That's why they released the stress test on February 4th. That's why they're modeling a 39% crash in commercial real estate. That's why they're preparing for 10% unemployment. They're telling you, in the most bureaucratic, technical language possible, that the system is breaking, that the banks are going to fail, that the economy is going to collapse, and that you need to position yourself accordingly. They're giving you a roadmap. They're showing you their hand. And if you're not paying attention, if you're still watching CNBC and believing the narrative that everything is fine, then you're going to get destroyed. Because the next phase is going to be brutal. The next bank failure is already baked in. The next wave of commercial real estate defaults is already happening. The next leg down in the software sector is already starting. And the next surge in silver is already building. The physical market is tightening. The vaults are emptying. The lease rates are rising. The backwardation is deepening. And the price is going to reflect that. Maybe not today, maybe not next week, but soon, very soon. And when it happens, when silver breaks above 121 again and keeps going, when it hits 150, 200, 300, the people who sold at 74 are going to be in shock. The people who believed the margin hike narrative are going to be in denial. And the people who took delivery, who bought physical, who understood what was really happening on January 30th, they're going to be positioned for the greatest wealth transfer in modern history. So let me summarize this for you. On January 30th, 2026, 3 things happened simultaneously. Silver crashed 30% in 6 hours due to a coordinated margin hike and algorithmic attack. The Metropolitan Capital Bank in Chicago failed, marking the first bank failure of the year and exposing the insolvency of the regional banking system. And the software sector lost $285 billion in market cap, signaling the end of the intangible asset bubble and the beginning of the rotation into physical, tangible assets. Those 3 events are not isolated. They are connected. If the Fed is quietly preparing for it, then what does that tell you about the current state of the banking system? It tells you that Metropolitan Capital was not an isolated incident. It tells you that the commercial real estate crisis is systemic. It tells you that there are dozens, maybe hundreds of regional banks sitting on loan portfolios that are worth a fraction of what they're marked on the balance sheet. And it tells you that the Fed knows this. They know the banks are insolvent. They know the system is fragile. and they're trying to manage the collapse in a way that doesn't cause a panic. They're trying to let the air out of the bubble slowly, one bank at a time. But the problem is, markets don't work that way. Once the confidence breaks, once people realize the emperor has no clothes, the panic happens all at once. And that's what January 30th was really about. It was a warning shot. It was the Fed and the bullion banks sending a message to the market. The message was this: we are still in control. We can still crash the price of silver whenever we want. We can still force liquidations. We can still shake out the weak hands. And we will do it again if we need to. Because the alternative where silver runs to $200 or $300 or higher, where the paper market completely decouples from the physical market, where the entire fractional reserve bullion banking system is exposed as a fraud, that alternative is unacceptable. So they crashed it. They used the margin hike to create forced selling. They used the algorithms to amplify the move. And they used the chaos to drain the vaults and cover their short positions. But here's the problem. It didn't work. Not completely. Because yes, they crashed the price from 121 to 74. Yes, they shook out the leveraged speculators. Yes, they created panic and forced liquidations. But the physical market didn't break. The bid for physical silver didn't disappear. The premium on physical coins and bars didn't collapse. In fact, it went the other way. Dealers sold out. Mints couldn't keep up with demand. And by February 10th, just 11 days after the crash, the spot price had already recovered to $82. It bounced, and it bounced hard, because the underlying fundamentals didn't change. The supply deficit didn't change, the industrial demand didn't change, the geopolitical tension didn't change. All they did was give the smart money a chance to buy physical metal at a 30% discount. And speaking of fundamentals, let's talk about what else happened on January 30th. Because the silver crash and the bank failure weren't the only major financial events that day. There was a third domino, and it happened in the technology sector. On January 30th, Anthropic, the artificial intelligence company, announced a major strategic shift. They announced they were pivoting away from software as a service. They were shutting down their consumer subscription model. They were restructuring, and the market interpreted this as a signal that the AI software boom was over, that the valuations were too high, that the revenue models didn't work, and the result was what some people are calling the SaaSpocalypse. The software as a service sector collapsed. In a single day, January 30th, the software sector lost $285 billion in market capitalization. $285 billion, gone. Now you might be asking, what does a software crash have to do with silver? What does Anthropic have to do with the Metropolitan Capital Bank? And the answer is everything. Because what you're witnessing is a rotation. A massive, violent rotation out of intangible assets and into tangible assets. For the last 15 years, since the great financial crisis, since the Fed started printing money and suppressing interest rates, all of the investment capital has flowed into intangible assets, software, cloud services, cryptocurrencies, NFTs, things that don't exist in physical form, things that are just code, just data, just promises. And those assets got bid up to insane valuations because there was infinite liquidity and zero cost of capital. But now the regime is changing. The liquidity is draining, the cost of capital is rising, and people are starting to realize that when the system breaks, when the banks fail, when the currency collapses, your software subscription is worthless. Your cloud storage is worthless. Your digital tokens are worthless. The only things that have value are things you can touch, things you can hold, things that exist in the physical world. And what are the most important physical assets in a world where artificial intelligence is the dominant technology? It's not software, it's hardware. It's the servers, it's the chips, it's the data centers. And what do all of those things need? They need silver. Every AI server, every data center, every high-performance computing cluster, they all use massive amounts of silver. Silver is the best conductor of electricity. It's essential for the electrical contacts, the circuit boards, the thermal management systems. And here's the key point. The demand for silver from the AI sector is price inelastic. That means it doesn't matter if silver is $30 an ounce or $300 an ounce. If you're building a data center, you need silver. You can't substitute it. You can't use less of it. You have to buy it regardless of the price. So when the software sector lost $285 billion in one day, where did that money go? Some of it went to cash, some of it went to bonds. But a lot of it is going to flow into the physical infrastructure that supports the next generation of technology. And that means hardware companies, that means semiconductor manufacturers, that means data center operators, and that means silver. Because without silver, you can't build the physical layer of the AI economy. And the smart money knows this. The institutions know this. The people who were selling software stocks on January 30th are going to be buying silver on February 15th. They're rotating from the intangible to the tangible, from the digital to the physical, from the imaginary to the real. And this rotation is happening at the exact same time that the banking system is breaking, at the exact same time that commercial real estate is collapsing, at the exact same time that the Fed is quietly preparing for a 39% crash. Is that a coincidence? Or is it a pattern? Because if you zoom out, if you look at the big picture, what you're seeing is the end of a monetary regime. You're seeing the death of the everything bubble. The bubble that was inflated by 15 years of zero interest rates and quantitative easing. The bubble that made software companies worth more than car companies. The bubble that made commercial office buildings in dying cities worth billions of dollars. The bubble that made regional banks look solvent when they were sitting on massive unrealized losses. That bubble is popping, and it's popping in real time. And the people who run the system, the Federal Reserve, the Treasury, the big banks, they know it's popping. They're not stupid. They have access to the data. They know the commercial real estate market is toast. They know the regional banks are insolvent. They know the software valuations were absurd. And they're trying to manage the collapse. They're trying to do it slowly. They're trying to avoid a panic. But the problem is, the market is smarter than they are. The market sees what's happening. The market sees the bank failures. The market sees the stress tests. The market sees the rotation out of intangible assets. And the market is front-running the collapse by buying physical assets, by buying gold, by buying silver, by buying things that will hold value when the currency loses value. And that brings us to the paper-to-physical ratio. The ratio of paper silver contracts to actual physical silver available for delivery. At the beginning of January, before the crash, that ratio was about 250 to 1. That means for every ounce of physical silver in the Comex vaults, there were 250 ounces worth of paper claims. 250 people thought they owned the same ounce. And that's a system that only works if nobody asks for delivery. It's a fractional reserve system. It's a confidence game. But after the crash, after 33 million ounces were drained from the vaults, after the registered inventory dropped from 98 million to 64 million, the ratio went to 356 to 1, 356 paper claims for every 1 ounce of metal. Think about what that means. If you own a silver futures contract, and you decide you want to take delivery, you want the actual physical metal, there's only a 1 in 356 chance that metal exists. The other 355 claims are unbacked. They're just promises. They're just entries in a database. And as long as nobody asks for delivery, the system works. But the moment people start demanding physical, the moment the deliveries spike, the whole thing collapses. Because you can't deliver what you don't have. And right now, the Comex doesn't have it. The vaults are at the lowest level in years. The lease rates are spiking. The backwardation is screaming shortage. And the people who understand the game are taking delivery as fast as they can. And it's not just happening in the United States. This is a global phenomenon. On February 12th, just 2 weeks after the silver crash, bank employees in India went on strike. A nationwide bank strike. Millions of workers walked off the job to protest working conditions and wage cuts. And India is one of the largest markets for physical gold and silver in the world. It's a country where people don't trust the banking system, where people save in physical metal,